Hello and a warm welcome. You've joined us on Markets at Noon right here on ET Now. I'm Ashesha Advaryu, with me Snehi Shah. And first up, we have several analysts and managements joining us from GM Financial Conference, and from the sidelines of that conference, we now have Raghvesh, insurance and capital market analyst at GM Financial Institutional Securities, now joining us. Raghvesh, thank you so much for taking your time out. And since you track capital markets and insurance, first up, let's talk about the capital marketplace then. And we've seen SEBI raise several concerns about excessive retail activity and options and FII activity as well. If SEBI continues tightening rules, where do you see this headed, and your outlook on the capital marketplace as a whole?
Yeah, hi Ashisha. First of all, thanks for having me on the show. So in terms of what SEBI has done over time, they have taken a number of steps to improve the market for retail participation. While over time, if we see for a company like, say, Angel One, they have seen bouts where the activity has reduced and they have seen their revenues being variable during that time. But over time, they have recovered through these regulations and through the market cycles. So whatever SEBI decides to curtail or improve the market, the retail participation, I think it will be in the best interest of the industry. Companies like Angel One, which are now diversifying and have actually diversified into multiple products, like they're not just a broker anymore, they are into wealth management, they are into asset management, getting into insurance. So over time, in the medium term, even if there is something coming in, the idea is they recover in a medium term, say 1 to 2 years, and the revenue and profits growth are back on track. In the wider capital markets, I have a preference for the wealth managers over brokers at this point. Even asset management companies are doing pretty well. The key idea being that the inflows into the system, while they have reduced this from last year levels, remain robust. What used to be around 6 to 7% of the opening AUM as inflows has structurally improved to 12-13% in equity AUM. For the wealth managers, that number is around 12 to 15%. For the larger guys, 25% up plus for the smaller guys. So one, the AUM itself is growing pretty steadily. Secondly, even if the mark to market is not very strong, the markets do not give good returns, the inflow component itself makes sure that the companies report at least decent profit growth year after year. In terms of preference, I like 361 in the space. Yeah.
So that sounds good. Mr. Raghvesh, hi, good afternoon. This is Snehi also joining in the conversation. If you could help us understand what the positioning in the market is right now in terms of domestic institutions as well as FIIs, because domestic institutions, they have been steady buyers for months. Do you think they keep absorbing any big bout of FPI selling, or is there a limit to how much support they can provide at the moment?
So, of course, I'm not a strategist, but what I focus on is the inflows numbers which are coming into the mutual funds, the life insurance companies. So if we look at the mutual fund inflows number, equity plus hybrid minus arbitrage inflows were broadly at a 45,000 crore per month run rate in the last year. That has reduced to around 36,000 crores, around a 20% decline in this year. What we have seen is that the numbers had really picked up in 2Q. Before, we have seen some profit booking in October. So at somewhere around a 36 to 37,000 crores, 40,000 crores inching up, that number, there is space for the mutual funds themselves to absorb whatever paper is coming in and the FII selling. Secondly, what really stands out is the SIP book. Again, SIP book has, through volatility, kept on inching upwards. Right now, it stands at around 29,500 crores per month, which is a pretty strong number. Coming to the other DIIs, life insurance funds, ULIPs continue to be a preferred product. If we look at the leading life insurance companies which I cover, we have seen continuous improvement in the ULIP products. which have been taken up very well by the companies. There were companies which were not focused on that product, say even 2 or 3 years back, because of the margin profile, because have now innovated the product to suit their customers and the companies themselves over time. So I remain pretty positive on the inflows number for both the mutual fund space as well as the life insurers.
Understood. So that's as far as the capital marketplace is concerned and the mutual fund in the SIP industry. But let's also talk about insurance, because that is also one sector that you track very, very closely. After the GST rate cut announcement that came in, what kind of a bump up are you expecting? I understand the second quarter was impacted on account of GST transition-led disruption. But now going forward, do you expect a big jump up as far as growth is concerned? And within the broader basket, which subcategory do you like the most within the insurance sector?
Broadly, 3 main segments within insurance have been positively impacted by GST 2.0. First, of course, life insurance. Within life insurance, there was the expectation of some kind of cuts coming in protection policies, which are the pure term plans for some time. The positive surprise was that even in the savings lines of business, GST has been exempted on the individual policies. Second, of course, health insurance, which has been very widely talked about. If we see the last month numbers, growth has been exceptional. I think the standalone health players have seen health insurance grow 30% plus, which is extraordinary. The third, of course, is the motor segment within the general insurers. That is a function of improving volume growth for the underlying industry. Net, in terms of growth, the biggest push is coming in health insurance, and the numbers are already visible. In life insurance, what we are seeing is, while the ITC impact is having a bearing on their margins, but because the product mix is shifting, because the protection product has seen a price cut. By a price cut, I mean what a customer is paying, including GST, after a long time. I think for the first time since COVID. So there is a very strong pickup. We are, channels suggest growth of around 5% on a YOY basis. That should help their margins. I'm pretty positive on the life insurance space at this point. Health insurers have done well on growth and continue to do well. But within the broader general insurance space, I like a company like ICICI Lombard, which is growing through its health insurance space, also has the other businesses in motor, fire, which provide that higher ROE, which some of the health insurers, which are uniline businesses, do not have. So net positive on the life insurance space, and on the general insurance space, prefer the multi-liner ICICI Lombard.
So that sounds good. And Mr. Raghvesh, also give us a sense on the GST impact on insurance, the premiums that we've seen go from 18 to 0. What has the impact been on companies in terms of their margins, do you believe, now that has been neutralized, or what is the time frame do you think these companies will take to put that entire GST impact behind them?
So broadly 2 segments again, the general insurers and the life insurers. So general insurers, it's essentially how much they can pass it on to the distributors. The sense I'm getting is they have been able to do a pretty decent job of it. The Sahis, of course, they came out with a press release saying that from 1st of October, that is 3Q, they have passed on the entire commissions that they were paying to the distributors is now inclusive of ITC. So that, my sense is, around 75 to 80% of their expenses. So there the impact should be minimal. Over time, the expectation, of course, is that the products themselves are innovated so that the customer value also increases and the distributors also take a lower hit. Coming now to the life insurance companies, where has not been that straightforward. So what the companies have mentioned in their 2Q con calls is essentially we get numbers anywhere from 170 odd basis point impact on their VNB margins for the full year to somewhere on a 400-450 basis points number. Now this is the gross impact without any changes due to the ITC being unavailable, given that the product level itself GST has been exempted. Now, what happens now is, as I was mentioning, the protection growth has really been very strong. Around 50-55% is even what we are hearing from some of the channels. Now, protection is the highest margin business for these insurers. Essentially, the higher risk you underwrite, the higher margins you get. Similarly, on the entire group business, Credit Protect, which is another high margin business, has been pretty slow in the last year, in line with the retail credit growth in the company, in the broader economy. So there also we expect a fillip. So my sense is maybe we see an impact in the 3Q numbers, but going into 4Q, the VNB margins for the life insurers should be back in line. My estimate for almost all the companies I cover is that the second half margin should be better than the first half, despite the entire impact of GST 2.0 and the ITC loss, which was just there for 8 to 10 days in the first half and coming for the entire second half. I still expect the margins to be better. In terms of growth, because the fillip has actually been seen in the protection business, which is the lowest ticket size, growth numbers do not see a very significant bump up. My growth estimate for the private industry for this year was somewhere around 12%. They are already tracking at around 10%. Maybe we see an addition of, say, 100-200 basis points, which is a pretty decent number at 13-14%. But right now I'm sticking to my 12% growth estimate for the year, which was down at around 8% in the first half. So maybe 13-14% in the second half.
Okay, so that's as far as your growth estimates are concerned for the second half of the year and for the full year. But also wanted your thoughts on the key drivers within insurance. Will it be ULIPs, participating or non-participating policies? Any category that you expect to outperform versus the other?
So right now the market is very good for the non-participating products. So for non-par products, what we focus on is what is the pricing power the companies have. So on the one hand, we have the deposit rates, which I have public data available from the RBI. The system-wide fresh term deposit rates have actually reduced in the last 6 months with the RBI cutting repo rates. On the other side, we have the GSEC yields, which have been pretty stubborn at around 6.5%. So the difference between these two, which is now up to I think somewhere around 100 basis points, that gives a good pricing power to the life insurers to offer benefits to the customers. So I'm pretty positive on the non-par products in the second half. Again, non-par annuity, similar phenomena. On the par product, it's more company specific. There are companies which are not very strongly present in the segment and are trying to grow the segment. Say a company like SBI Life has done pretty well on the par business. Max Life has done pretty well on the par business. They can see the par business grow. On the ULIPs, to some extent we cannot expect the strong growth we saw in the last year, especially because a ULIP product is very, very similar to a mutual fund. Of course, has the additional protection component. And as I was mentioning, the mutual fund inflows have seen around a 20% dip year on year. So that way the ULIP product growth should theoretically be lower, but what we have seen is the companies have innovated their product mix. Now, typically a person who would get a 10x cover on the premiums he or she was paying, now that cover has moved up to 30 times, 40 times, which makes the product more beneficial to the customer. So while the market is very strong for non-par product, I think the customizations and the innovations people have done on the ULIP products make them attractive. So the sense is while the growth will be highest on the protection, but given its lower margin, in terms of the quantum of growth, I think ULIPs would be at the top, followed by the non-par plus annuity segment, and followed by protection.
Okay, so that's the view coming in on the insurance sector. Raghvesh, thank you so much for taking your time out and joining us here on ET Now from the sidelines of the conference and helping us understand what the outlook is not only for the insurance sector but for the capital marketplace as well. On that note, we need to slip into a very short break, but more news and updates and several other managements joining us after a quick